How can the election affect the taxes you pay? What are some things you may need to think about as far as estate planning is concerned as it relates to the election? What if you own a small business? Do you need to think about selling that this year, next year, or after the election? What are some things you need to be thinking about as far as protecting your assets in today's society? Is there a way you can sell a business and pay no capital gains tax? What's the difference between an asset sale and a stock sale? Is it advantageous for you to be able to sell the stock or sell the assets? What are portability issues when it comes to estate planning? And if you're given company stock in your retirement account, what are some ways that you can pay capital gains tax on that money versus ordinary income? And if you're a retiree and are paying a lot of money towards healthcare costs, is there an opportunity for you to do Roth conversions? If you're a business owner and you have a large net operating loss, could that be an opportune time for you to do Roth conversions? And what are some capital gain strategies that you may be able to implement to help you tax-wise over the course of your lifetime? We're going to be going over a lot of these questions with Chris Hennessy. He is a tax attorney and a CPA. He is a professor at Babson College. Welcome, Chris Hennessy. Chris, we got a lot going on here. What would you like to start off with to be able to discuss, to be able to help clients and business owners make some good decisions going forward?
Well, I think we should talk a little bit about the big picture, which ties into the election, Jeremy, but more importantly, what will happen after the election that will impact planning, tax strategies, estate planning strategies, et cetera, for clients, for people that are going to view this podcast.
Perfect. Well, let's get started with that. What is it about the election that is top of mind that we need to be thinking about?
Well, most people it's the debate, but let me back into that. All right.
Okay.
So if we go back to calendar year 2017, obviously Trump's in office. Republicans passed a major piece of tax legislation known as the Tax Cuts and Jobs Act. Because of the way that was legislated through a process called reconciliation, most of it expires at the end of 2025. Now, that was a major tax cut. A lot of individuals saw a cut in their individual income taxes, and same thing with business owners. But it's going to expire unless, of course, it can be renewed. So that connects us to the election. So if Trump were to win, and I'm not going to get into the details about the debate. We all know what's going on right now. Right now, he is ahead in the general polls. But of course, we do not have a general election in the United States. We have an electoral college election for president. But he's also interestingly ahead in all 7 swing states, but within the margin of error. So we'll see what happens. But in any event, if Trump wins, and he has what I call the trifecta, the House and the U.S. Senate, he will be able to extend Tax Cuts and Jobs Act. Now, there is a cost to that. The Wall Street Journal had a great article. I've got it in front of me. Republicans, this was May 28th. Republicans, $4 trillion question. Should they pay for extending Trump tax cuts? So there's a significant cost of $4 trillion over 10 years, and they're going to have to deal with that. So planning-wise, tax rates stay the way they are for most people today. But if he doesn't win the trifecta, maybe he has the Senate, but not the House, or Biden or someone else, whether it's Kamala Harris or whoever it is, wins, then Tax Cuts and Jobs Act would not totally be extended. Biden has said, look, I want to keep tax rates the same for the people making under $400,000. He says families. So I think, Jeremy, that's probably, he's referring to total income, not taxable income. But, in any event, that's a different story. So I wouldn't do any significant planning. Let me give you an example. Maybe I'm thinking about selling my business. Maybe I'm thinking about taking a large gain. Maybe I've got some income that I can take into income this year or next year or wait. A good example would be the exercise of stock options. Well, we're going to know a lot on, November 7th? Hopefully by November 7th, we'll see. And that way, we'll see how the political process into 2025 plays out, and then you can decide on major planning. Another really good example would be you have a large charitable pledge. Well, if Tax Cuts and Jobs Act goes away, I'll just give you a quick example. The marginal tax rate will go up. The top marginal rate today is 37%. It'll go to 39.6. I want to get the most deduction for my large charitable pledge. So why wouldn't I wait until 2026 to pay that pledge off rather than doing it in 2025? And with stock options, a non-qualified stock option, when it's exercised, is regular W-2 income. Wow, my tax rates are going to be lower in 2025 than in 2026, right? I want to exercise in 2025. So anyway, that's the big picture that's going on, and it will be clearly interesting to see how it sorts out. I often say I'm an equal opportunity insulter in both parties, but also I would not want to be living in one of the so-called seven swing states between now and election day. I'm going to be besieged by political ads and so forth.
I hear what you're saying. So in other words, like if we have to pay taxes, it might make more sense to pay taxes between now and the end of 2025.
Correct.
If we're trying to get a tax deduction with the idea that it's possible that the tax rates could go up, we may want to wait to get that deduction more meaningfully after 2025.
Right. And I suppose, Jimmy, part of the big picture is, and these are all my own opinions, part of the big picture is the deficit, right? So roughly the country brings in about $4.4 trillion of revenue per year from taxes and spends about 6.4. So there's going to be a $2 trillion deficit. Now, to put that in perspective, back when the Republicans passed this major legislation back in 2017, the budget deficit was 3.4% of our economy, of gross domestic product. That's basically, for anyone viewing this, that's basically our economy. Now it's about 5%. So the deficit is growing as a percent of our economy. And anyone watching and hearing this podcast knows that we've had inflation, but also people realize that the interest costs, the interest rates have gone up. So for a long time, the U.S. government got away with an interest rate of almost zero on a 10-year treasury. Today, it's not zero at all. It's much higher. It's somewhere in the range of 4.5%. Actually, the average weighted cost of the debt is about 3.2% right now. So our interest costs on $35 trillion of debt are going to be almost $1 trillion. So we're going to have to deal with this in some way as we think about keeping these tax cuts in existence, or maybe there are some they call them pay for, some stuff that actually you got to pay for. Wow. And of course, Congress would never cut spending. I mean, that's right. Isn't that the real solution?
Tax and spend. Once you get it to spend, then that's the new baseline of spending going forward, right?
That's exactly right. Yeah. That's exactly
right. Now, would the president have to have the House and the Senate to extend the Tax Cuts and Jobs Act?
No, or just one? They'd have to cut a deal. So let me give you an example. Let's assume Trump wins and he has the U.S. Senate. Now, why am I saying that? Because the Senate is Democratic. Well, there are 34 U.S. Senate seats up for re-election, but about half those Senate seats are Democrats. So it's pretty likely, a little more than, I think more than half, pretty likely the Senate goes Republican. Typically, the House of Representatives follows the coattails of the president. So why would I go in and vote for Trump, a Republican, and then vote for a Democrat in my congressional district? I probably wouldn't, right? But for the sake of argument, let's assume that the Senate does stay Democratic, the House is Republican. So Trump doesn't have the trifecta. He's got the presidency, he's got the House, but not the Senate. Okay. To get legislation done, he's got to make a deal with the Democrats because they control the U.S. Senate. So I'll give you an example of a deal that I think is kind of interesting. Democrats want to increase the corporate tax rate from 21% to 28%. 21 is really low. As recently as 2017, that rate was 35%.
Yeah.
So it's very low. Okay, so Trump goes to the table and says, all right, I'm willing to go for 21 to 25%, but in exchange, I want the estate tax exemption to stay where it is. Well, it's today 13.6 million. It'll be up a little higher index for inflation. That would be an example of a deal. And it's an interesting deal because the entire revenue from the estate and gift tax in this country is $33 billion a year on a revenue base of 4.4 trillion, right? It's a political issue. It's a political issue.
You said the estate tax is how much? 30 what?
33 billion.
33 billion a year is the estate tax issue.
Yeah, state and gift tax.
Which is really not a lot of money at all.
No, and why? Because what do wealthy people do? What does Warren Buffett do? What does Bill Gates do?
They give it away.
They give it away.
Right.
Exactly. They have to, because if they died with, owning a majority of the stock in Microsoft or in Berkshire Hathaway, how they have to sell, the estate would have to sell a lot of shares to pay the estate tax, and that would drive the price down. Right. So they give it to foundations.
Yeah. Okay. All right. That makes sense. So what I hear you saying when you're talking about estate planning and tax planning, a lot of that's going to be predicated on it could potentially be predicated on who wins this election.
That's
right.
Exactly right. Yeah, who wins it? Do they have the House and do they have the Senate?
Right. And then also, like, if there is planning that needs to be done, you really need to have your horses in alignment, or ducks in a row, so to speak, before the end of 2025.
Right, exactly.
Right, so you can execute. Now, we try to do is when we have everybody's estate, we try to have everybody's estate documents in order, and all their titling of all their assets, not only held with me, held outside of me, documented. And so that when we are working directly with an attorney, now, what we do is we work with CPAs and attorneys, and sometimes tax attorneys like yourself, into executing these documents. We try to make it really, really easy, and that making it easy also hopefully makes it a lot quicker to execute and be nimble in the light of a lot of things that could transpire. So,
that's very smart, because if there were going to be a major change, then you have to get ready for it. And sometimes, if it's a major change in the estate taxes or estate planning, the attorneys get so busy that they get backed up and then they can't get to it. So you walk in December, the change is you got to get something done by the end of December. It's going to be really hard to do.
That's right. That's why we really work to have great relationships with attorneys, but we also try to make it really easy for them too. I mean, working with us, really makes it easy for them, or at least we try to. And so let's just suppose, for instance, the estate planning exemption went from 13.6 or so.
Yes.
If the tax exemption drawback expires, that would drop the estate tax exemption down. So wealthy people, if we thought that it was going to expire, then they may want to do some family gifting before 2025.
Before the end of 2025, correct?
Before the end of 2025, to capture what is the delta between 7 and 13.
Yeah, exactly. So there's a misconception that, I got 13.6 and my spouse has 13.6, so I'll just use that in 2026. That's not going to happen. If the exemption amount comes down to, let's say, 7 million in 2026, because of the way it's complicated, but the ordering, you're going to lose the opportunity. So the push that is going on planning-wise now is, let's use an example. Someone's worth, because I've done a lot of calls with people in this situation, someone's worth, say, 30 million. That's a good number. And you're saying, okay, between now and the end of 2025, you and your spouse should give away, out of that 30, should give away 26. How do I get 26? $13 million each, right? That's 26.
Mm-hmm.
That leaves you with 4. And they're going to say, what are you, nuts? I'm not going to do that. So the lawyers are saying, yeah, but there's a way you can do it and retain indirect access to the funds. And this is called a SLAT, meaning a spousal lifetime access trust. So let me step you through it so everyone understands it.
Mm-hmm.
I create this trust for my wife. Her name's Susan, and I fund it with $13 million. Now, she could actually be the trustee of her own trust. And if she's the trustee, she can take money out of her own trust for her own benefit, as long as it's for health, welfare, support, or maintenance. And who are the ultimate beneficiaries of her death? Our children are, right? So indirectly, I gave away 13 million. I got that 13 million out of my estate. I used up my $13 million exemption, and all the growth in that 13 is out of my estate, and it's out of Susan's estate. That's pretty cool. Now, what if I want some money, Jeremy? Hey, I want a new Mercedes. So I go to Susan and say, hey, I just gave you 13 million in trust. Write a check out to the Mercedes deal. That's not going to work. That's not health, welfare, support, and maintenance.
Otherwise called HIMS clauses.
Yes, right.
Yeah,
that's exactly right. Otherwise, I really kind of have indirect access to the funds through her. Now, that's pretty cool. Now, what are the risks? Well, one risk is we get divorced. We're coming up on, I think it's 42 years of marriage. So I don't think that's likely. But you
Right.
do have to discuss that with clients. And one of the complications is if that gets discussed, you got to have separate lawyers. You can't have the same lawyer representing both of you. A second risk is Susan dies, the money goes to the kids. I no longer have indirect access to it. Sometimes life insurance can help with that. Now, one final point. If I can set this up for her, she can do the same thing for me. But there's something called the reciprocal trust doctrine, which means if she does the same thing for me, probably ought to wait a year, or at least you have to have a different trustee and different terms of the trust. So this is being pushed a lot. And to go back to your earlier point about working with attorneys, get ready, because if Trump doesn't get the trifecta and Tax Cuts and Jobs Act does expire at the end of 2025, there'll be a big push, people in this 30 million and up category, to get this done. You can't wait until the end of 2025.
Yeah. It's just going to be a backlog. It's like somebody yelling fire in a crowded theater. Everybody's going to be rushing for the exits.
Right. Exactly. So that's a big issue in estate planning. But, I think also, Jeremy, we should talk about the basics of estate planning.
Yeah. Portability, things like, absolutely.
Yeah, because not everyone's worth 30 million, and not most people aren't. I know I'm not. So.
Of course, all the listeners and all the viewers right now are worth 30 million. Okay.
So let's just go through it, because it's kind of interesting. You don't think about this often. I find people put off the basics because it is about death ultimately sometimes, and they don't want to talk about that. But obviously you need a last will and testament, and that's important because that will cover any property you die with in your own name. What people don't understand often is that when they named a beneficiary, so they have an IRA account or a retirement account or life insurance or an annuity, then there's no probate needed. We can talk about probate in a minute. So you got to have a last will and testament. And if you got minor children, you've got to name a legal guardian. Who's going to take care of those kids if something happens to?
And they could be real cute when you're inheriting 30 million.
That's exactly right.
That's important.
That's really important. Then healthcare proxy, and I'll use two examples here. One, there's a famous Florida case. The case was about Terry Shiva, unfortunate woman who was on life support equipment for some 15 years and did not have a medical directive of healthcare proxy. So there was a fight between her husband and her parents as to shutting off the life support equipment. A lot of that could have been avoided had she had a medical directive. Second thing is, you'll never think about this. So you're down there in Myrtle Beach, and you send your kids to college up here in Boston. And one of your kids gets up here and gets sick and ends up in the hospital. They're 18 years old. Obviously, you and your wife are going to call the doctor up in the hospital. How's my son or daughter doing? And the doctor cannot talk to you because of HIPAA, federal law, unless that child has signed a health care proxy under Massachusetts law, naming parents, you and your wife, as agents. Never think about this. So what I tell people is, look, get the child to do that, PDF it, parents should have a copy of it on their iPhone, and then you can just fax it to the hospital.
So pause there a second, okay? So this healthcare proxy, that's a state document, a state document.
It is.
Yeah. Okay. All right. So those things, it's dependent by state. So when you say and move from, let's say, South Carolina to Boston, we need to be careful that making sure that we have a healthcare proxy signed in the state that the child is going to be domiciled in.
Correct. Right.
That's
and
right. Okay.
Still have one probably in South Carolina. And you know what's interesting? There's a website. I have no interest in this website. I've checked it out. It looks pretty good. Called Mama Bear, MAMABEAR, and it's got all these forms on it because, to your point, it's regulated state by state. So people should check that website out. Yeah, probably sometimes you should consult with an attorney, particularly if there are complications. I'm not saying, I'm a lawyer myself. I'm not saying don't use an attorney, but sometimes this form is so simple for a teenager that you go to this website and get it done. So that's really, really important. And then along with that, not necessarily for teenagers, although they should have one, it's called a durable power of attorney. So if something happens to, let's say, me, either physically or mentally, and I can't handle my own financial affairs, my bank account, my checking account, my investment account, I'm probably going to name my wife as agent to act on my behalf if I'm incapacitated. And then there'd be a backup, usually an adult child, although it could be a good friend. So that's really important to have, durable power of attorney. And then I mentioned probate earlier. So sometimes when I give a live presentation, I say, okay, famous American died August 16th of 1977. If you're older, you usually have some sense. It's Elvis.
Is that as Elvis?
Yes, that's correct. Elvis Presley.
Ah, well,
And the reason I use him, believe it or not, when he died, his entire estate was 5 million. Now, in today's dollars, I don't know, that's 25 million. Allegedly, the colonel took a lot of his money, but in any event, 83% of that $5 million to get his estate probated because of the mess he left.
wow.
So you want to try to avoid or minimize probate. Probate is a legal process, again, governed state by state law. For any assets that you own in your own name, like a house or bank account or whatever they are, have to go through probate. The ways to avoid probate would be set up your accounts, transfer in death or payable in death, or very commonly in estate planning, you have what's called the living trust, trust that you create while you're alive, and you fund it with these assets that are in your name now. They go into this trust. Your spouse can be the beneficiary and the trustee of this trust. It reads just like your will, but anything at death that's owned by this trust is not subject to probate. And you know where I've seen this, Jeremy, a lot? I can remember a case I had years ago. A woman was dying of cancer. One of my clients, she had 3 children. She had a home in her own name, no debt on the house, and she's going to die in a month. I went out to see her. We got everything set up. We got that house into the trust for the kids. So when she died, the kids could put that house up for sale right away and get rid of it.
Question there.
Yeah.
Because like that there's some mistakes that a lot of times people tend to make is when they add a kid to the we're talking about cost basis. So a lot of times people live in Myrtle Beach and they have kids in Boston or wherever, and they want to add a child to the property with the idea of making it easier for them. But if they did that in the cost basis, if there's a lot of equity in the home, the cost basis is X and the value is X plus 2X, then they lose the step up in cost basis.
Right. That's exactly right.
Yeah. So if you kind of maybe comment on that.
Yeah, sure. So oftentimes you get mom's father died, mom's alone. She's got the house, got a daughter. So she's, I'm going to put the house in my daughter's name, or I'm going to be co-owner with my daughter. So now, to your point, when mom dies, there's not a full step up to fair market value. So the cost was 100. I'm just using low numbers. And at death, the fair value of the house was 1,000. Well, normally, if I die with that house in my name, the cost becomes 1,000. My daughter can sell it and pay zero capital gains.
Let's repeat that. The cost basis of the home is 100,000.
Yeah, 100,000. Let's say, yeah.
And let's say, for instance, that the home is worth, and this is realistic. Let's say the home is worth $1 million.
Sure. Yeah.
Let's say it's worth $1 million.
Yep.
All right. Now let's play out this scenario in this example.
So then, if I died owning the home in my name, the cost basis is no longer 100,000. It becomes $1 million.
That's right. And so you don't have to pay capital gains if you sold it for $1 million. But if you put it in the daughter's name,
the daughter's cost basis is still 100,000.
Yeah, and so if she sold it, then it would be. Now, let me ask you this: does it get a little nuance whether you're in separate property states or in common property, community property states?
Yes, community property. There's a full step up.
Okay, in the community property states, and those community property states are generally along, let's say, Texas, along the southern border, all the way California being another one.
Right.
Wisconsin, I think Louisiana. If they want to get, but most of like East Coast separate property states where this step up in cost basis is important.
Right. Now, there's another reason it's interesting in this example that I should think carefully about gifting the house to my daughter. Who are my daughter's creditors? Is my daughter married? What if she gets divorced? What happens to the house? Right.
Okay. Play that out.
So I say, well, then the other thing I'm saying to myself, well, let me get the house in my daughter's name because that'll protect it from the nursing home. That comes up a lot too. We can talk about that maybe later on. And so I put the house in my daughter's name. My daughter's married, been married 5 years, and then they go through a divorce. And her husband makes a claim on the house that I gifted to her. That would not have happened had I not gifted it to her. In addition to the capital gains example we just talked about.
Yeah, so this adds another wrinkle to the situation. You mentioned earlier, and this is one thing. There's a number of assets that avoid probate naturally if you name the beneficiaries properly. So let's go through those.
Yeah, sure. And then I want to make a point about this that often catches people. So anytime you name a beneficiary, so where would that apply, Jeremy? Individual retirement account, Roth IRA account, life
That's right.
insurance, an annuity
Annuities. Yeah.
contract. Those are, I think, the major ones that would come up. Now, one of the things that sometimes happens is, so I've done all that, great, but then my wife dies or we get divorced and I forget, oh, she's the beneficiary of my IRA. And now she's no longer my wife. We just got divorced, right? That's a big problem. Or another issue that comes up, I haven't done that. So a lot of times when you're dealing with the custodian, some asset management company, the custodian, the default is my estate. Oh my gosh, now my IRA is going to be payable to my estate, go through the probate process, right? So this is really important. I tell most people, review who the beneficiaries are at least every couple of years, if not more frequently. Have a checklist of that.
That's right. Matter of fact, when we have these blue folders every time we meet with a client, guess what we have it? One of the things we have in there, beneficiary information. And guess what? There's a lot of times where, hey, my daughter's going through a divorce or something, or we're thinking about separating. There's a lot of times that can potentially be an issue.
Yeah, that's right. Really important to go through that. So that's the naming of a beneficiary. And also, I mentioned it quickly, but a lot of times when you have a bank account or a brokerage account, you can set it up payable on death or transfer in death.
Yeah.
So you actually go in and you name a beneficiary.
Yeah, that's right. So you name a taxable account.
So that's pretty good.
It's not necessarily a tax deferred type of account like a Roth or IRA or annuity or 401k. You can name a taxable account a TOD. Right. And now the TOD, it avoids probate and it gives a step up in basis. Is that correct?
Correct, yeah.
Provided? Okay, perfect. All right. So what about like gifting low cost basis investments, stock or something? So sometimes like we have wealthy families that want to help out children, right? Or grandkids. And then there's a thought process around, hey, what do we write them a check? Or what about low cost basis stock? It matters. It can matter what assets they give. Any comments on that?
Yeah, sure, Jeremy. So people don't realize that the capital gains rate, if you're under certain income limits, is zero. So I'll give you the numbers, and then let's tie back into your question, your comment. So if I'm single, I can have up to, let's say, round it off a little, $47,000 of income and pay zero capital gains. If I'm married, I can have up to actually, married is up to $94,000.
And this is, and you get the standard deduction on top of that too.
Yeah. Oh, yeah, that's right.
You can have close to $120,000 worth of income and pay zero capital gain.
Exactly right. So I've got let's say I have a daughter going to law school at Stanford. She has zero income, zero.
And you're proud of your daughter going to Stanford too.
Well, and the tuition's $60,000 a year. So how does it get paid? I write her a check for $60,000. Check to the Stanford Law School for $60,000. Now, what would have been a better strategy? Well, I've got some stocks in my portfolio that are pretty low cost basis, to your point. I could gift those stocks to her, let her sell them up to those income limits we described for single. Now, you got to watch out for what's called the kiddie tax, but as long as she's 24 or older, we avoid that. And then as a family unit, we've saved money because if I sold those stocks, I would have a capital gains tax to pay. But if she sells them, no capital gains tax. Now, there is a gift tax. People, again, should try to understand the way the gift tax works. The gift tax is a tax on the right to transfer property. But we all have, on an annual calendar basis, an $18,000 exclusion from the gift tax. So I can always give away $18,000 to my daughter, and my wife can give away $18,000. So that's 36. Now, what happens if we go over that magic number, or those magic numbers? We reduce my lifetime amount of $13.6 million. It's irrelevant unless I have a federal estate tax problem. And to have a federal estate tax problem, I got to be over, in today's law, over $27 million.
Okay, so let's get into a little bit of nuance there, because I think a lot of times people get that confused. Yeah, they can give more. It just reduces the amount of their lifetime exclusion. How do you technically track it so that it's compliant?
Well, technically, if it's over this $18,000 amount, I'm supposed to file a gift tax return, which is called a Form 709. It's actually due on April 15th. I'm supposed to file it. I'm not going to owe anything, but I'm supposed to file it, and that's the way I should be keeping track of it. I think as a practical matter, a lot of people give away cash to kids over these numbers, and it never gets tracked, it never gets reported. That's technically the way it should get actually tracked.
Yeah, perfect. And we ask for tax returns on the clients so that we can get an idea of what their incomes typically are going to try to be
Right.
by the end of the year. Now, here's where an issue happens.
Mm-hmm.
We hold people's money right now typically at Fidelity. Okay.
Mm-hmm. Yeah. Yep.
And we're able to see all the investments that they have with us. However, if they got bank accounts or an outside brokerage firm somewhere else and they're trading stocks or doing these things, it affects what our estimates are on their capital gains, ordinary income, and things like that. So if we're thinking in terms of, hey, you're going to be right at $110,000 worth of total income in 2024, we need to take a capital gain on something and then rebuy it back or whatever the case may be and pay zero capital gains. Right. It would be affected by these are the outside assets. Yeah. And so that's why, like, when we're talking about with clients and other people, really making sure that you've got somebody looking over all of it. And if the right hand doesn't know what the left hand's doing, there could be some issues and add some complications.
Yeah, you make a really good point, Jeremy, because if you have a situation where someone's their income is relatively low for a particular year, and so they could go, to go back to those numbers about capital gains, right? If I'm married, it's up to 94,000. So let's say I've only got 60,000 of income. Well, plus the standard deduction, right? As you mentioned. So I can take some capital gains, and if I like the stock, I can just buy it back, right?
That's right. So true story. This is probably about 15 years ago. I had a client who had about a $300,000 worth of unrealized gain in a stock.
Yeah.
This couple had almost no other income. They weren't even taking Social Security. They just lived very, very simple lives. And they must have, I can't remember the exact number. They might have only had $40,000 worth of income total. And I'm like, I'm thinking about this. And I'm like, hey man, you might be able to sell some of this stuff and not pay any capital gains. So we get on a three-way call with his CPA just to run the numbers.
Yeah.
Right?
Yeah.
And that's what he did. And you got to do that. Let's say those are types of planning things that need to be done before December 31st.
Right. Another good example would be the Roth conversion. So the problem with the Roth conversion that people don't like, and just to back up, this is taking, let's say, an IRA account and retitling it into a Roth IRA to make it tax-free. So the problem is, if I've got $100,000 in an IRA and I want to retitle it to a Roth, I'm going to pick up $100,000 of income on my tax return. Well, let's look at what my tax bracket's going to be for 2024. I can do that towards the end of the year, to your point. And if I'm in a low bracket, kind of a rule of thumb that I like is 24% or less. So I got a tax rate chart right in front of me. In a married tax return, I could be in 24% or less if I'm under $383,000 of taxable income. So that's not a bad time to think about the Roth conversion. Now, the problem is if I go over that number, I jump to 32%. That's a big jump. That's a 8%.
Yeah. And then also taking into consideration to that point, if people are, when they're going from working to retired, their income typically drops dramatically.
Right.
Now, one thing they need to be mindful of in the area of retirement is how that might affect their Medicare cost.
Right. Yep.
Which goes, and we do that through tax planning too, as well. Is like, well, they may pay 24%, but it also might bump them up into paying a little bit more in healthcare, and it may still make sense.
Right. It may be
and to do that Roth conversion.
Yeah. Exactly. Yeah. Yeah. Because Medicare premiums is based on income, and there's a 2-year look back. So you're absolutely right. You got to say, okay, if we do this Roth conversion, you may end up paying. Let's look at the chart. You may end up paying more Medicare premiums, right?
That's right. You may pay, just making this numbers up, You may pay $1 more in healthcare premium, but you may reduce your future taxable income by $2.
Exactly. Yeah.
You know,
Exactly.
so you weigh those pros and cons, and we do that through tax planning. But a lot of times, just people don't think about it. Let me give you a story here. I was talking to this guy, and he just cashed out of $500,000 straight up out of his 401k, just straight up cashed it out. He was ticked off with the world for whatever reason and bought some investment property. And he's like, well, I did the math and I'm at whatever, 32%. I'm like, okay, how did it affect? Did you see how it affected your Medicare costs? No. Did you see how it affected your taxation on Social Security? No. Did you see how that net investment income tax? No. I mean, all these other complications come into play when you don't think about it.
The other one's financial aid. So the ability to qualify financial aid.
Financial aid, you say?
Well, if your income suddenly spikes up because of a Roth conversion, let's say, yeah.
Okay, it affects financial aid.
It could
okay. Yeah. Okay. I didn't know that. Oh, interesting. I love that. That Roth conversion stuff is pretty damn popular right now. I mean,
yeah. So I have a couple of thoughts on that, Jeremy.
Okay.
To go back to our conversation, you know, people, once they understand why they're doing it, it makes a lot of sense if your income in the future, when you're going to take down an IRA account through required distributions, is going to be the same or higher than it is today. Because in effect, what you're doing in the Roth conversion is you're prepaying the taxes today. Well, if you want to prepay the taxes, try to do it when your tax bracket's lower, right?
Right. Now, it's tax arbitrage.
Tax arbitrage. Now,
that's right.
There are a couple of strategies that help, that can offset some of that income, or maybe all of it, that's being generated by the conversion. One would be business owners. So business owners, good examples, a sole proprietor or someone that's got what's called an S Corp or an LLC that's treated as an S. All that means, folks, is the income flows through to your own return. And if that business owner has operating losses, not capital losses, real business losses, there was a lot of that in COVID, particularly in the hospitality business, but not just hospitality. Those operating losses come forward in time. So you got a big negative number in your tax return. So the operating loss comes forward in time until it can be used up against income. So how could I create income just like that? Roth conversion.
Roth conversion. So yeah. So you're taking wow, that's a beautiful way to take pre-tax money.
Right.
You put into a tax-free Roth.
Right.
And possibly paying hardly any taxes at all.
Exactly. Now there's another strategy that when I first came up with this, and began to talk about it, I said, this is going to be rare. But then I found out it's not so rare. And it's medical costs. So let me again kind of step through an example. So medical expenses on your tax return are deductible to the extent they exceed 7.5% of your income.
Mm-hmm.
So let's take a scenario. I've got someone who's in a nursing home with Alzheimer's. They're 73 years old. They have $1 million in an IRA, and that's it. So their only income is the IRA income required, which wouldn't be a lot in $1 million, and probably Social Security. So the nursing home says, okay, the medical cost of this unit, I'm going to make the number up, is $150,000.
Mm-hmm.
So that's deductible to the extent it exceeds 7.5% of your income. Well, how much income would you have on a $1 million IRA? What's your
depending on their age, probably maybe 40 grand, 50 grand.
Yeah, maybe that's even, I think, high. So they're going to have a deduction of over $100,000 from the tax return, a negative number on the tax return. So how do they offset that negative number? They take some of that $1 million and convert it to a Roth.
Right, which in turn will, if they reduce the amount of their pre-tax IRA account, it will reduce their future required minimum distributions.
Right. Exactly right. Yeah.
Which is a kind of a snowball effect.
And I should make clear in that example that I'm assuming in the example this individual is not on Medicaid; they're self-paying. And sometimes that happens.
Well, let me ask you this though: if they're on Medicaid, which means I'm just going to use my words, they don't have a lot of money.
Right. That's correct. Yep.
If they had a pre-tax IRA of $1 million, that would preclude them from qualifying for Medicaid.
Depends a little bit on the state, but generally the answer is yes. I ran into this recently. I was looking at someone, I happen to be in Massachusetts, and they were in, I think it was in Massachusetts counts IRAs as countable assets in the Medicaid test, which most states do. So that's right, Chairman. Most states do.
Yeah. Okay. All right. But great point. In other words, like there could be some opportunities for retirees and business owners to accelerate the Roth conversion process if they have a net operating loss or an exorbitant amount of medical expenses, which could be nursing homes and the like. And so that now, obviously, when people are listening to this or watching this video, they need to make sure they talk about this with their CPA and their tax attorney before they execute this type of stuff. These are just thoughts that to consider and to be mindful of. It's like, oh, wait a second. I heard these really bright guys talk about this on this on this podcast, and maybe I need to reach out to somebody. All right.
It's a great point because it illustrates the need for a financial advisor. I mean, you're in a situation, Jeremy, where you can quarterback this process with people. And, a lot of people are doing their taxes today on TurboTax. I do my own on TurboTax, but I'm a tax lawyer, right? I know this stuff. Right. I'm a CPA also. So it's easy for me, but for the average person, these are all great ideas, but they've got to meet with somebody, review these thoughts, right? And to get them done.
That's right. That's correct. And hopefully they're living their best life. They're doing things. They're playing golf. They're spending time with the kids. They're spending time with their grandkids. They're focused on growing their business. They're doing these things that only they can really do. And I'm like, I got a guy who cuts my own grass. Number one, I hate it. Number two, that I'm able to spend more time doing things like this that are much more meaningful to me. And so definitely working with somebody who is thinking through this type of stuff. That's what we work to do. Okay. And we ask a ton of questions. We have an 82 question checklist that we go through when we're going through a discovery process. Yeah. My goodness, why do you need to know about, if my daughters are married, and how long they've been? I mean, because guess what? All this matters. I don't know. Right. So if we can see the world through our clients' eyes, knowing what they know, but also knowing what we know, maybe we can plan into the future and anticipate some of this stuff so we can talk through this. Now, from the client standpoint, Chris, they need to run things. I would encourage them to run things by us because they may overlook something, right? Oh, hey, doc, I got a headache. Yeah. Well, maybe you only have a headache, right? Or maybe it's a real problem, right?
I agree.
True story. I mean, all the story I tell you is true. I didn't make it up unless I'm telling you it's made up. I had this lady call me one time and she's like, Jeremy, I hate my job. I just want to retire. And I asked her a bunch of questions, right? And she really lived off a very frugal life. And I said, you got this amount of money in your retirement account? Yeah. This amount of money for Social Security? Yeah. And I'm like, let's call her Betty. I said, Miss Betty, you could retire today. What are you like? She's like, really? I'm like, yeah. I'm like, well, you're going to work today because you want to, not because you have to. But she didn't even know that she could retire.
Right. Yeah.
So a lot of times, like to your point, Chris, is like if someone's able to take this net operating loss and do Roth conversion, they may not have a clue of anything about it unless they're talking to somebody who's thinking about this type of stuff.
Yeah. And I'm going to mention something. I've been practicing almost 50 years. And one of the biggest changes I've seen that has to be dealt with is the whole digital world. So passwords, all this stuff is on your computer, all your accounts, all your credit cards and how you pay them. So gosh forbid, if something happens to me, I do all that stuff in the house, right? How is my wife going to figure this out? She's got to first of all, she has to get into my computer with the Windows password, right? That's the first step. Then she's got to figure out where are all these other passwords. So I think it's really important that there be a trail of that. And that's sort of new because, we didn't have all this 15, 20 years ago that we had to deal with. And the other thing that concerns me, and when I teach my MBA course, I put this under estate planning. I'm not sure it's the right spot, but is the whole digital world in the context of people hacking into your computer, stealing passwords, computer security, cyber security, all that stuff. And that's really, really important what you do about that, what you actually do about that. I went to a seminar once, Jeremy, and the presenter had written a book about this, and he said, look, your social security number is out there. Somebody's got it. It's just a question when they use it. So
that's right. Hey, and let me say this. For the first 10 people who take a snapshot and subscribe to the podcast and subscribe to the YouTube channel,
okay,
and they email us, I will give them a book on how to protect themselves from cybersecurity.
That's great.
Okay?
That's
first 10. Yeah, first 10. All right. Okay. So yeah, we have a number of checklists that we go through, and guess what? It's not perfect. And I'm sitting there thinking, as you're talking, Chris, really, I'm like, what would my wife do? I know we have a lot of things down, and we are doing a lot of things, but how would that be handled?
Right. Exactly.
Yeah, that's why we keep a lot of things in a digital vault.
Yes.
Here.
Right.
I say here in the cloud for clients that's extremely secure. And so that, like you, what you're saying is like, what would my wife do? We take the client through both clients through the scenarios, because if something happened to whoever loves to do this financial planning stuff, usually the other spouse doesn't.
Correct.
If something happens to one spouse, the other one just doesn't have a clue.
Right.
And we really want to make sure that we arm this person with the information needed so that it can help them make the best decisions going forward, and so that they can live their life, because it's a tremendously taxing emotionally.
Now, I had this happen with a good friend of mine, a lawyer, friend of mine that I went to law school with, became a lawyer, got married, and unfortunately he died about 3 years ago. And his wife had no clue over any of this stuff. And she had no money. She's trying to figure out, how do I get money into my account? So I stepped in and I helped her, and I was able to do so. But what a mess it is when you don't take these steps that you're mentioning.
That's right. And all this is, we're in a retiree town. Roughly 50% of our clients are retirees,
right.
And we've had, it's part of life. We've gone through it, and I created a blog, a checklist for what to do when someone passes away. And so feel free to click in the show notes here, or in the comments, or not in the comments, feel free to click in the description about that blog if you want to read about it. Let's talk a little bit about portability.
Oh, sure. I mentioned, we skipped that one.
Yeah.
So this is something, it's interesting because it's been in the tax laws for some time. It's not part of Tax Cuts and Jobs Act. So it's not going to expire with Tax Cuts and Jobs Act. So here's what it's about. It's basically this is federal law. I don't know of any state that has this, individual state, Jeremy. So at my death, if I were to leave everything to my wife, Susan, there'd be no estate tax issue because of something called the marital deduction. So again, I'm just going to make up some numbers. I die, leave everything to her, and none of my $13.6 million exemption is used because I left everything to her. So if somebody files an estate tax return for my estate, even though it probably wouldn't be due technically, and elects portability just by the word means that my estate tax exemption, my 13.6 million, transfers over to my wife, Susan. So she has her own 13.6, and now she has 13.6 from me. So she's got 27 million. I think it's really important because we can't predict what in the future the estate tax exemption amount is going to be. Now, let's play it out. 2026 comes, Tax Cuts and Jobs Act expires. So Susan's 13.6 million, my wife's 13.6 million, goes down to 7.
But yours?
But mine doesn't go down. It's static at 13.6. So that's one reason. Now, there's another reason. It's a little more technical and complicated. Let me explain it. Step up to fair market value, which
9 months, right?
Yeah. So at my death, I left everything to her, and there was a full step up to fair market value at my death of all those assets. And then when she dies, there's another step up. But what if I hadn't done this? What if I'd set up a trust? And at my death, I'd left everything in the trust for my wife, Susan. Well, there'd be a step up at my death, but no step up at her death, because She doesn't own the assets, the trust does. Portability, she would own the assets, 2 step-ups. It's just something that when you're doing estate planning, you should think about portability, particularly at death, because oftentimes the estate tax return might not get filed because there's no need to file it, and you should probably file one and at least elect portability.
Okay, so let's talk about a little bit about the alternative dates.
Yeah, sure.
Okay, so you got date of death as being which is, and you have the dollar amounts of the, let's call them securities, at the date of death, and you have an alternative date of death.
Right.
Alternative date that you can look at what the asset values are. Is that correct?
That's correct. 6 months later, yep.
It's 6 months later, not 9 months. Yep. 6 months later. Okay. So you can choose which one would be the best for in other words, let's play it out for a second. If the account value, and if you're looking at my hands, it's lower than this one. If 6 months later it grew, you may want to choose the later one so you can get a higher step in basis.
Correct. Particularly if there's no estate tax, it's good to be due, right?
Yeah, that's right. Yeah. And if the state taxes does come into play, you might want to do the opposite, right?
Right. Correct.
Yeah. Now, we talked about alternative date of death. The 9 months that I was originally thinking about, that has to do with portability though, right? The 9 months.
That's when the estate tax return is due.
Okay. So we're talking about two things. The estate tax, the alternative date of death would be choosing what date may be most tax advantage for cost basis.
Right.
And that's 6 months, but the portability of it and making sure that each spouse gets their marital exclude. No, it's called the
exclusion amount or the exemption.
Exclusion amount. That's 9 months.
That's
706, right?
706, right? Yeah.
706. Okay, perfect.
And Jeremy, one thing we should mention is that we're talking about federal, but there are many states, particularly East Coast states, that have their own little death tax going on. So, for example, in Massachusetts, there is an estate tax at the state of Massachusetts level. It's a 16% rate, but the exemption amount is now $2 million a person. It was $1 million, and they raised it to $2 million. So it's much less. And there are other states that are similar. Not a lot of states, but there are some. So you've got to think about that in terms of planning.
So wow. So state tax.
Yeah. I'm fine federal, but I got a problem with the state.
Yeah. Well, that's no joke. That's also one reason why we relocated retirees moving into state need to make sure that they're looking at their documents
right
in the new state.
That's correct. Yeah.
By the way, guess what, Chris? We have a relocated retiree checklist too.
Oh, that's good. Yeah. Yeah. Well, I go to Florida and snowbirds is what they're called in Florida. So
that's true. Chris, let's talk about, let's say an employee gets some stock, okay? Yep. And into their retirement account. Is there a way, and I'm giving you a big fat softball pitch. Is there a way that an employee who receives company stock may be able to pay capital gains tax on that stock versus ordinary income, which could be much lower?
Right. It's called net unrealized appreciation.
Yes.
So
perfect. Tell us what net unrealized appreciation is.
So I always use, I don't know why, but I always use Procter & Gamble. I just randomly use that company to illustrate it. So I'm working at Procter & Gamble. I have a 401k plan, and I put P&G, Procter & Gamble stock in the plan. And I do this, every year the stock goes in the plan. Sometimes it's a benefit to me. Sometimes there's no cost to that. And then I want to retire or separate from service from Procter & Gamble. So at that point, I could take everything in that 401k plan, the P&G stock, other assets that are in the 401k plan, and transfer them to a IRA account. But I could also carve out just the employer securities, the P&G shares, and transfer those to a regular taxable account. Everything else could go to the IRA. Now, everyone's going to say, well, boy, you don't want to do that, because if you go from tax deferred or so-called qualified to non-qualified taxable account, it's going to trigger an income tax. It does trigger an income tax, but not on the fair value. So let's say the P&G stock is worth $300,000. When I do this, I don't pick up $300,000 of income. I pick up as income the cost basis of those shares is they were bought over time in the 401k plan. So let's say that number is 40 grand. So I pick up $40,000 of income on my tax return.
Not the 300.
Not the 300, right?
That's right.
Yeah, the difference between 340 is 260. Okay, so now I'm sitting with P&G stock in a taxable account. If I sell it, I have a $260,000 long-term capital gain automatic.
Okay.
So your point earlier is important because if that 260 ended up in my IRA, it's got to come out at regular income tax rates as high as 37%. If it's a capital gains rate, under current law, that's 20% plus potentially a 3.8% surtax. So there's a big spread between the two. That's
big. That's net unrealized appreciation. Yep. We've done that with a couple clients ourselves. It's a big difference. There's a big difference between, let's say, 20% roughly to 37%.
Right. And the real point of that example is the lower the cost basis, the better, because that's what I got to pick up as income. Now, here's something that people would never think about. I'm going to use a different way to explain it. The company stock price has gone down. I'm working for this company. I'm not going to name any company. And the stock price has really gone down. So I got a ton of company stock in the 401k plan. The trading price is $10 a share. But my cost basis is $40 a share. So I'm underwater, right? There's no NUA, there's no appreciation. So always with NUA, you want the lowest cost basis possible. Is there a way I can reset it? The answer is yes. I call this NUD, net unrealized depreciation. This is all plan specific. This is perfectly allowable under the tax laws. You got to look at your plan. Most plans will allow you to do what I'm about to describe. I put in a sell order. Sell all my company stock at the trading price inside the 401k plan, trading price of $10 a share. Sell order goes in. Usually takes 3 days to clear. 3 days later, what do? I buy back the shares I sold at 10. Why? That's the new cost basis.
There you go.
The old cost basis was 40. The new cost basis is 10. There's no immediate tax impact. And by the way, some people viewing or listening may be thinking about what's called the wash sale rule. Does not apply here because we didn't do this as an individual transaction. There's no wash sale. Okay, so now I continue to work for the company for a couple more years. I want to leave, I want to retire. The stock's traded up to $80 a share, and I want to use NUA. What do I pick up as income per share? 10.
10 versus the 40. Yeah.
Exactly right.
That's right. And that's very similar to being able to take tax gain harvesting.
Yeah, exactly right.
That we previously talked about as well. And so it's like, hey, these are things that we need to think about. Yeah,
exactly right. And it's fascinating because I won't name, you can think of companies that are down price, but one area where I could see this apply right away is biotechs. So, these biotechs apply for FDA approval of a particular drug. It gets denied and they'll drop in price 20, 25% immediately. And you got company stock in the plan. Reset it. And by the way, in the example, Jeremy, if the stock, I use $10 a share. What if the stock drops to 5? Can I do it again? Yeah, and just reset it again, right?
Yeah.
Most plans, it's a 3 days you got to wait. Some plans it's 30 days, but most it's 3.
That's why it's like you really need to. I would encourage people to be very, very whoever they work with to be very comprehensive because there's things like this that could come into play.
Right.
All right. So that's net unrealized appreciation. By the way, we've done a couple blogs on that topic. We can click those in the comments in the description of the podcast here. So let's talk a little bit about, let's say, a business owner.
Right.
Let's say a business owner has done very well and was thinking about selling their business. Okay. So let's talk a little bit about, number one, what this person needs to think about. Number two, if there is a way to be able to sell this business and possibly pay no capital gains tax.
Sure. So first thing I always think about with business owners, if they have a partner or partners, what type of agreement do they have? Do they have an agreement with those partners? Usually called a buy-sell agreement. We can come back to that, Jeremy, but that's important. Okay. Next thing is, what type of entity is the business? Is it a C Corp, meaning it's a separate taxable entity, or is it an S Corp? These are tax designations. Is it an S Corp? It's set up under state law as a corporation, but what did they elect for taxation? because that's important to answer your question. So let's assume it is a C corp, and when the shares were originally issued to the shareholders, the assets of that company at cost basis, not at fair value, were under $50 million. So it's a startup at that point. And 5 years has gone by. In other words, the company has been in existence for 5 years. Then you're going to sell the business, and you're able to actually sell the shares. Now, we can discuss the alternative in a minute. So the shares get sold. Under the tax laws, this is called qualified small business stock. It's also known, anyone likes to read the Internal Revenue Code, it's section 1202. So when those shares are sold, 100% of the gain is not taxed to the greater of $10 million or 10 times the cost basis.
Right.
Interesting about the 10 million is you can stack the tens, 10 million per taxpayer. So if I'm going to sell my business and I got 3 kids, that's 4 taxpayers. So it's 40 million. Now I would have to gift ownership over to those kids, probably in trust. There are gift tax implications and so forth, but it could be 40 million.
Does it start over the 5-year clock if you gift it?
No, it would not. The clock would keep going. It's a great question, by the way.
Yeah.
I should mention there are some types of businesses where this wouldn't work necessarily. And I'll just tick them
There's a
off.
bunch of exclusions in that.
Yeah, it's fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, and so
Service business.
service
Typical-
businesses.
Typical
But
service.
what's really fascinating is this part of the tax laws has been around since 1993, and there's not a lot of case law or rulings. So you may think you fit into one of those categories, but you do some research and you're okay. And I'll just give you an example. I mentioned insurance. So I had a case, a guy was down in Florida. He had a property and casualty insurance business, and that was not considered to be insurance because he was an agent. He wasn't actually manufacturing and selling the insurance directly. It came from insurance companies. So he was okay. Biotechs are okay. So it's a really interesting section of the tax laws.
What about so other types of service businesses, landscaping, blue collar type stuff, roofing companies, things like that. They have to be a C corp.
Correct. So let's go back to that point.
Sure.
There are a lot of S corps today that are profitable, really good, usually family businesses, but they're paying taxes at a 37% rate. Now, there is something called QBI, Qualified Business Income, which is a deduction. That's going to go away, by the way, when Tax Cuts and Jobs Act expires. But even with that deduction, they're paying taxes at a 29% rate on the business profits. If they became C corps, 21%. So
because corporate tax rate currently is at 21%.
Right. So some S corps are thinking about becoming C corps for that reason. Now, this is something clearly CPA has to get involved with, run some math, some scenarios, and some. But it's something that should be looked at, and then the CPAs are going to say, oh yeah, but most of the time, the corporate shares are not being sold. The assets of the company being sold to a buyer. So goodwill, trade name, furniture and fixtures, maybe a building, customer lists. Those are typical, right? IP, intellectual property.
That's right.
That's true. But even so, what would happen would be the C corp would sell those assets to a buyer, be a 21% tax, so that the cash would come into the C corp. They'd pay the 21% tax, and the C corp's then going to be liquidated and dissolved. Can you use the $10 million then? Absolutely, you can. Absolutely, you can.
So the structure of the sale. So Chris,
Yep.
the structure of the sale, whether it's a asset sale or a stock sale, would not necessarily preclude it from getting the qualified small business stock advantage, because the retaining money from this is going to be in the C corp, and they can just simply dissolve it from then.
That's correct. That's absolutely right. Yep. Absolutely
Okay.
Right. And if you think about what I said earlier, make this final point, the greater of 10 million or 10 times the cost basis. Okay, to go back to where we started, to qualify, I got to be up to $50 million of assets at cost basis. So if I put $50 million into the company, that's my cost basis. What's 10 times that? 500 million.
A lot.
That's a
Well,
lot.
okay, let's play that out for a second. When companies are looking to raise money and doing these things, what about if they raised a little too much and they raised 55 million? Would that mean that they give up the entire amount of
That's a good question. The first 50 million would be okay.
First 50, they can capture that. Anything over and above that would be okay.
There's another question I get a lot. Well, gee, I'd love to do this, but I've only had the C Corp for 3 years and I've got a buyer. Now what? Okay. Then there's another section of the tax laws that allows you to roll the gain over.
1045.
1045. Yeah, that's pretty good. roll the gain over to a new qualified small business stock.
Yeah.
And you don't reset the clock. This whole area of the tax laws was pushed to Congress from Silicon Valley. It was pushed by the private equity VC firms that were funding these startup tech companies out in Silicon Valley.
Yep. Speaking of which, I believe Y Combinator did some things and it's called stock appreciate or stock assets, future equity stock.
Future earnings, maybe. Yeah, I don't know.
Yeah. That's very interesting. Okay, so all right, let me ask you a different question here. Let's say somebody's an S Corp and that they wanted to convert to a C. Does that start the clock at that level?
Yeah, it would start the clock then. What you'd actually do is you'd dissolve the S Corp and transfer those assets to a new C Corp. In other words, a new entity is created. You transfer the assets generally to the new entity. There probably wouldn't be any tax consequences to that because with an S Corp, you're always paying taxes currently on the profits.
Okay. All right. I'll cover on the profits there. All right. So we did touch on briefly, and this would be more or less the exit planning for business owners. Okay.
Yes.
It is the asset sale versus stock sale. And there's certain nuances between certain advantages for a buyer for one, certain advantages for a seller for one. So let's talk a little bit about the nuances between asset sale and stock sale.
Sure. So what happens in the asset sale is you usually the seller negotiates with the buyer and they come up with a price. Let's say it's 10 million for the business. Then you allocate that 10 million to the assets that are being sold. So for example, I'll just go through a few customer lists. So let's say we allocate to a list, the sale of a customer out of the 10 million selling price. A customer list would be treated as capital asset, capital gain.
Okay.
We allocate 3 million to goodwill, again, treated as a capital gain, Jeremy. Then we allocate, $1 million to furniture and fixtures. Well, okay. Any depreciation that I've taken on those furniture and fixtures comes back to me as ordinary income. So that's, and then intellectual property, which probably is going to create capital gain. So, and then there might be a covenant not to compete. So the buyer says, I don't want you competing with me, so I'm going to pay you a covenant not to compete. Well, that's going to be regular income on the transaction. So it's important because the tax situation of the buyer and the seller may be different. The seller wants to not have as much allocable to capital gain because they want to depreciate these assets, right? So it's a negotiation. Whereas if we were just selling shares of C Corporation stock, that's all capital gain.
Okay.
Yeah, well, just one thought. It's interesting because a lot of businesses are being sold today. You know why? They're worried about the capital gains rate going up.
Into 2025. Yeah.
Yeah, exactly.
Yeah, that's right. And then when a business owner is selling, there are gains in capital. There's capital gains and there's ordinary income. Now, what they may want to try to do is maximize the capital gains taxation of it and reduce the ordinary income taxation of it.
Right.
But it could be that the buyer may want the reverse. They may want to buy things so they can depreciate them in the future and make it more tax advantage that way.
Right. And to go back to our snowbird discussion. So if I'm going to sell a business and I'm in a state like, I don't know, New Jersey or real high California, right? Maybe I want to get domiciled in Florida or Texas or South Dakota. Or actually, your state, I think, is pretty low too. So
right. Yeah. Yeah, that's right. That's exactly right. Maybe want to, and then, okay, so let's play that out for a second. How long do you have to be of the state of domicile before you're able to complete transactions?
Generally speaking, I know what Massachusetts does. Generally speaking, you got to be not in the state, but out of the other state. So I was living here in Massachusetts. I go to Florida. I got to be out of Massachusetts 183 days. I can be any place else, but I got to be out of here. And then I pick a state to be domiciled in. Let's say it's Florida. And then I go through the steps down there, driver's license, register to vote, address, professional affiliations, doctor. This is a whole checklist. I know you have it, and so forth.
But so some states so it's state dependent on whether you owe that particular state.
Yes, correct. Yeah.
Okay.
And sometimes you can't do what I'm saying because they're actually physical assets like real estate. And that's going to be harder to do. But if it's a service business, it's maybe easier to relocate.
Yeah, that's right. That's right. I mean, we got clients all over the country, so
yeah, sure.
Yeah, we're a service type business. Okay. See, the thing is this is really, really how you can add a lot of value to somebody.
Yes.
Stuff like this. This isn't just, oh, my widget's better than your widget. Right. This is like real shit. But people typically don't deal with it because it's hard.
Yeah, it's hard and it takes time, and you have to have an advisor that quarterbacks it and pulls it together because there's a lot of different parties involved. Lawyers, CPAs, maybe someone on the lending side. I mean, you get insurance, right? You get a lot of different parties involved.
That's right. So, all right, let's jump backwards a second.
Yeah, sure.
Let's talk about second marriages. A lot of times there's, retirees, they've lived their life, maybe their spouse passed away and they find love again. And so share with me some of the things that couples may need to think about as it relates to second marriages, because many times these second marriages, they have heirs from previous marriages. And so right. What are some of the complications and things that second marriages need to be thinking about?
Yeah, so the first thing I want to mention is make sure your beneficiary designations are updated. Let's say I lost my wife or we got divorced. Well, I want to make sure that she's no longer down as a beneficiary. The second thing would be, let's say this would be common either way, divorce or my wife died. I got kids from that first marriage, right? And ultimately, I want to take care of the second wife that I fell in love with, but I also want to make sure my kids get the fair share. So how do I do both? Well, Congress passed, and I guess they passed this, Jeremy, because so many of them were getting divorced. I'm not sure. That's the story, but it may not be true. So it's called a Q-tip. Q-tip means qualified terminable interest property. So I could actually say, at my death, all my assets go into a Q-tip trust for my second wife, and she must get the income from that trust on an annual basis. She can also get distributions of principal if needed. And there'd be a trustee, right? I got to find a trustee that does this. But here's the key. At her death, whatever's left in that trust goes to my children from the first marriage. Okay. So those kids are protected. That's very, very commonly done.
All right. And that would be a HIMSS clause if there were income over and above. Sometimes the children of the person who is leaving the assets in the Q-tip may feel even the surviving spouse themselves may feel like, oh my goodness, they're waiting on me to die, right?
Yeah.
Yeah. What are some of the things is there anything else that can be done?
Sure.
That could kind of
life insurance. Okay. So why wouldn't I, if I was insurable, and let's say I got 3 kids, and I say, okay, I'm going to go out and I'm going to buy insurance policy of my life. And name the 3 kids as beneficiaries so they get the death benefit right away at my death. They don't have to wait until my second wife dies.
There you go.
And if I'm worried about 2 things, first of all, if I had a federal estate tax issue, I'd have that life insurance owned by a trust. So the death benefit is not part of my estate. Or
that's right.
If I had any one of those 3 kids I was worried about in terms of being a spendthrift, then, I might say, okay, I got Teddy. He's a spendthrift. The other 2 kids are fine. So the other 2 kids get their share of the life insurance right away. Teddy's goes into trust. He's got to deal with the trustee to get money.
Right. And so in other words, the trust is put hooks or contingencies upon the income.
Right.
So that it kind of protects them.
And this is also an issue with large individual retirement accounts because, almost everyone names their spouse as the beneficiary, but then the kids, the children. Well, now under the Secure Act, big change in the tax laws, those kids have to take the account out within 10 years of the death of the plan owner.
100%. Yep.
So, if I got a kid that I'm worried about, and that's a lot of money for that kid to come into within 10 years, Maybe I name a trust the beneficiary of that IRA.
Right. And let's say that child also has addiction issues or whatever.
Yeah. Right.
Having things set up in a way that it spins down those assets, but also as it does it, maybe puts it in other types of accounts where that it's not fully liquidated and full access to it.
Yeah, correct. Yeah, absolutely.
Yeah. Yeah.
Yeah, one thing I always like to mention, let's go back to these business owners, right? And
Yeah. Perfect.
so this business owners had, business for a long time, and they don't really think about, okay, what if I got sued? Because the business, if it's set up properly, protects them from litigation involving an accident with the business, right? So, but now they sell it, and all of a sudden they've got, 20, 30, 50, 100 million bucks sitting in an account, taxable account. And I think they don't think about becoming targets. Now, no one
Asset
knows.
protection.
Yeah, no one knows they have it. There's not a sign on your back that says, hey, I'm worth 100 million now. I just sold my business. But usually what happens is they get into a bad auto accident. I mean, this is rare, but it happens. It happens. They get into a bad accident. They're at fault. Someone's killed or seriously injured, and they get sued. Well, the first thing plaintiffs are going to do is find out, oh, Google so-and-so. Oh, this guy Hennessy just sold his business. He's worth a lot of money. They're going to go after you.
That's right.
So what do you then do to protect your assets? And at the basic level is umbrella liability. Umbrella liability. That's number one. So let me explain that, and then you can come in, because I know you have some examples, Jeremy.
Sure.
So, I've got insurance in my home called homeowners. I've got insurance in my cars. Auto liability is part of that. The standard auto liability amount is $300,000. It varies a little, but it's usually $300,000. So I can put an umbrella policy on top of homeowners, on top of the auto. And a lot of people have it. They have $1 million. I don't think that's enough. Bare minimum, I'd go to $5 million. And when you go from 1 to 5, your premium doesn't go up by a factor of 5. It goes up a little, but not a lot. And now, okay, go back to this auto accident. So at least now I got a $5 million policy, and usually a plaintiff will settle maybe up to that 5 million, right? And sometimes I think, Jeremy, you could go up to as high as 10 without a lot of underwriting.
Correct. And then also there's other types of insurance companies that, I mean, maybe or maybe not this, but Lloyd's of London or some other type of that can maybe insure up to 20 million, let's say.
That's the auto example. Now, what else? People don't realize the house, right? You got a swimming pool, you have pets, you have children in the school system. What do children do now? They get on social media and they say bad things about teachers. The parents are liable. Oh, you got a 17-year-old driving cars that you and your spouse own. You're liable if that 17-year-old gets into an accident. All that has to be covered by raw liability.
My son's 19, total 2 cars. Total 2.
Yeah, I had the same situation myself.
Yeah. So. Yeah, the asset protection from wealthy people is a big deal. A very low barrier to entry to help secure that is umbrella insurance. Now, Chris, and you know this, what many people may need to do to get umbrella insurance, they may have low liability limits on their auto insurance or
right. That's correct.
Maybe increase that amount that would qualify them for that umbrella.
Right. It's often the same company that will insure all of it. And another thing that comes up, fraternities. There's case law on parents being liable. A fraternity gets sued because some kid got hazed and died or got seriously injured. The parents get sued. Umbrella will cover that. My umbrella will cover someone that hacks into my personal computers. One thing that it doesn't automatically cover is a second home. So, up here where I live, west of Boston, a lot of people have a house down on Cape Cod. They get down there for the summer. But some people also rent that house out on the Cape. Well, if they rent it out, it isn't automatically covered by the umbrella. So a guest gets hurt, a tenant gets hurt.
Yeah.
So you got to look into that.
Maybe they want to own that in an LLC.
Exactly what I was going to say. I mean,
yeah. So a lot of times what I'll see is a lot of people do is they'll put multiple different properties in different LLCs, right, so that it may silo that particular asset.
Yeah. Exactly.
There you go. Yeah. And the thing is that attorneys, people in general, can be default to lazy, right? So if it's complicated and complex to try to pierce an LLC, it may not be very interesting to an attorney. Hey, well, let's just get whatever we can, and that's where the liability insurance and the umbrella insurance could play a role.
And then the next level is more complicated because you get into physicians, doctors that do surgery is a great example. They have much higher malpractice risk. So sometimes they'll actually transfer their assets into their spouse's name because it's an at-home spouse that doesn't have liability. And that can work. It still raises the question about liability, right? And it also raises the question of, okay, if you're going to do that, you got to make sure that you have a secure marriage and what the divorce laws would be. And then the final step, which is for really wealthy people, is what's called domestic asset protection trusts. I think there are 19 states now that by state law. Nevada is a good example. Alaska, Delaware is a good example, and so forth.
Yeah. I was about to ask you about those, and that could be some advanced planning, and we've got attorneys that can do that for those types of clients as well.
Yeah, that's right.
What type of dollar amount of net worth do you feel might warrant something like that?
Yeah, I would say probably when are over 15, 20 million, maybe. It somewhat depends on the nature of the assets, how liquid they are, because people really don't want to go after property that's encumbered, and they don't want to own a business, and they don't want to own necessarily real estate with tenants. And I think the second answer, Jeremy, is looking at what's the risk you have as an individual, right? So I'll just use myself to illustrate that. Yeah, I drive cars, and I'm a good driver. I'm getting the discount on my auto, but my risk, people would say my risk is I'm a private pilot. I'm an instrument rated pilot. I have my own airplane that I fly, which by the way is owned by an LLC. I've never had a problem, knock on wood. But people would probably say, well, that's your risk, right? So I might be in a different situation with that.
Right. Perfect. I think this is very, very, very good. So let me pause for a second there. The topic we were just discussing. So what are some things that we can do? What are some things that business owners can do to help protect their assets? What are some things that business owner can do to protect their assets and their net worth?
Yes.
And then we want to know.
Yeah, and then I'm probably got to wrap up for another thing.
Yeah, I know you do.
So the basic thing would be when they create the business, what type of entity owns the business? Because if I'm a sole proprietor and I'm running my business as a sole proprietor, I have unlimited exposure to liability if I get sued. Now, I'm not too worried about that. I could have malpractice insurance as an attorney, so that would cover it, right? If I have partners in a partnership, I'm liable for their acts. So the next level would be, okay, law school 101, I got a business, put it in a corporation, a Massachusetts corporation, a South Carolina corporation, right? Okay, fine. Create a corporation, have the corporation own the business. And then what happens is that any liability that's created from an act of the business, so you get hurt in the business location, or the business sells a product that's defective, or there's liability for a service, then your personal assets are not exposed. You're okay. And that's true. But then you've got to think about what's the difference between a corporate entity and a limited liability company. And the big difference between the two is an LLC is less formal, much easier to create, but lawyers would say it's the difference between inside and outside liability. Let me illustrate it. Okay, if I'm exposed to liability because of what I'm doing, like I'm a doctor and I have malpractice liability, which doctors doing surgery would, but a lot of my other assets, like my properties, are owned by an LLC. If I get sued for malpractice, it's really hard for someone to take away that LLC that I own, which might be rental property, right? Or it might be something else. But if I had that rental property corporation, it would be easier for someone to take the shares of stock away from me. I won't go through any more details, and this varies a little bit by state, Jeremy. Okay. But generally, a lot of times today, the LLC is better as an entity than a corporation or a corporate entity under state law.
Okay, understood. Thank you so very, very much, man.
Yeah, have a great week, and I'll talk soon.
Yes, sir. Thank you. Bye.